Hello and welcome to the Cryptocurrency News channel. Today we're going to go over the basics of TA. We're going to go over 5 of these indicators. And of course, I'm going to explain exponential and simple moving average. So relative strength index, stochastic, commodity, average directional index, and awesome oscillator are what we're going to go over. And I'm also going to tell you guys like how I mesh a couple of these together to see some of my directional signals. Now, I don't really rely on TA at all. I don't have a strong belief in TA or chart analysis. I prefer fundamental analysis. And that's because I generally do long-term holding. And I don't do day trading or weekly trading even. I do long-term holding, staking, and yield farming. And those don't really work off of TA that much. But if you're interested in like day trading, like I guess you can try technical analysis. I've tried it before. Like it works sometimes, it doesn't work sometimes. It's nowhere near perfect. And I found that like long-term holding gives me just as good ROI as a TA trading or any kind of trading based on any analysis. So that's actually kind of like what I do right now. So let's actually go over these oscillators. The RSI is the most common indicator that you've actually heard of. Generally, this measures velocity and momentum. And the value ranges from 0 to 100 usually. Below 30 is oversold. Above 70 is overbought. So like right now, 38.49 would actually be neutral. So those are like the number bound ranges you actually want to look at. The stochastic is also like a momentum indicator, and what it does is it measures the location of the close compared to the high and low of a specific time period. So based on that, you can see like for that time period, is it oversold or overbought? Generally, the range is like if it's under 20, it is oversold, above 80, overbought. So right now, for instance, it's 14, so that actually it would be oversold. The commodity channel index is generally unbounded, but the thing is, generally we take negative 100 and 100 as kind of like the oversold, overbought. So negative 100 or more oversold, 100 or more overbought. However, for really volatile assets, you can do negative 200 and 200 as the oversold, overbought. And that generally measures variations from statistical mean. And it's a momentum indicator. It also kind of like measures reversals and divergences. As you can see here, the average, the commodity channel index is negative 115. That is definitely oversold territory, so it's telling us to buy. However, that's not always the case. You have to look at the commodity channel index against the other oscillators. You also have to look like, has the commodity channel index changed from negative to positive or positive to negative in the recent time? The average directional index goes from 0 to 100, and it kind of measures, like how strong the trend is. So for instance, if you have a RSI that's overbought and a stochastic that's overbought, the average directional index, and if the average directional index is strong, that actually may not be overbought. That just might be a strong buy trend. But if they're both overbought and the average directional index is low, that means there's no real trend and it could actually be overbought, so you actually want to sell. So that's how those work with the average directional index. That shows you how strong the trend is. So if the other indicators are really skewed one way and the average directional index is strong, that means there's a trend in that direction. If the other indicators are strong, but the average directional index is weak, then that means like we might be at a local top. So that's kind of how that relates. The awesome oscillator is generally, it measures market momentum. And what it does, it's a 5-day moving average minus a 34-day moving average. And the zero crossing is the most important event here. So it can measure trends and reversals. So if the awesome oscillator keeps on getting like more and more negative, then essentially like the momentum's negative. If it gets more and more positive, then obviously the trend's positive. However, the most important is the zero crossing, where it actually measures reversals. If it crosses like from positive to negative, then basically it reverses to bearish, and then if it crosses from negative to positive, then it reverses to bullish. That's how that awesome oscillator works. Now, the moving averages is the other half of it. The exponential moving average is basically, and the simple moving average differ in that the exponential average weights the more recent days or weeks or months heavier than the rest. So like A simple moving average of 10 days is just like, an average of 10 days, whereas an exponential moving average of 10 days weights the last day or two much heavier than, like 9 or 10 days before. Generally, if the exponential moving average is lower than the simple moving average, to me at least, that means that for that time period, it's actually bearish. If the exponential moving average is higher than the simple moving average for X time period, then for that period, the momentum is bullish. However, you have to look at the 10, 20, 30, and sometimes even 50, depending. Like for the days, you would look at 10, 20, 30, 50. For weeks, you might look at 10, 20, 30, 50. For the months, you definitely just want to look at 10, 20, 30. 50 is almost like 4.5 years or something. That's a little too much for crypto. So the thing is, like, if the exponential moving average on the 10 is bearish, but the rest of everything else is bullish, you can just kind of see that as a temporary dip, especially on the daily indicator. On the monthly indicator, it might actually mean something else because it's a very long period of time. But for the daily indicator, if the exponential moving average for 10 is bearish, but 20, 30, 50 is all bullish, that means it's a temporary dip. However, like if the exponential moving average for 10, 20, 30, 40, and 50 is, like bearish, then that actually might mean just an overall bearish trend. If it's like 10 and 20 that's bearish and the rest are bullish, then, you have to kind of make a decision on how long this bearish trend will actually last. Of course, the weekly and the monthly is going to differ from the daily. If you look at the weekly, 20 weeks and 30 weeks, 50 weeks is all buy, but 10 weeks is sell. So that means like if this 10-week block is over, the next 10-week block will probably be bullish. So that's kind of how it works. You have to look at like if the recent block of time is bearish or bullish for a short-term momentum indicator, but you also have to look at longer periods of time for a longer momentum indicator, especially if you're at the end of like a candle. So that's kind of how you read these averages of the RSI, the stochastic, the commodity channel index, the average directional index, the awesome oscillator, the exponential moving average, and the simple moving average for different blocks of time. That's basically how I read these simple technical analysis. I also do take the longs and shorts into consideration as well. So I hope you enjoyed this segment. Hope you learned a little bit from it. And TradingView on the technicals for Bitcoin is a great way to actually get started in technical analysis. So that's the news for today. Let me know what you think. Like and subscribe and hit that bell notifications button. Thank you and have a nice day.